What if the very thing you fear is actually the secret weapon of the wealthy? The truth is, a loan can propel you 10 years into the future, but only if you use it to build something that lasts 10 years. Most people believe borrowing is a burden, but for the wealthy, it is a strategic accelerator. A loan has the power to bridge the gap between where you are and where you want to be, decades faster than saving a loan. But there is a golden rule. The smart borrow to build assets. The foolish borrow to fund consumption. In this audiobook, we are about to rewrite your financial reality and teach you how to make every borrowed dollar return a profit. We strip away the fear and focus on the math, the discipline, and the precision required to use debt as a lever for wealth. You will learn how to turn a dangerous obligation into a powerful servant. If you are ready to stop working for money and start making money work for you, hit the like button and subscribe to our channel. Let's begin your journey to financial freedom. Chapter 1. Borrow for investment, not consumption. Quote, "Rich people use debt to leverage investments to grow cash flow. Poor people use debt to buy things that eat cash flow." You are standing at a precipice, and the decision you make regarding how you handle borrowed money will determine whether you spend your life as a master of your financial destiny or a slave to the banking system. It is time to strip away the comforting lies society has told you about money and face the cold, hard mathematics of wealth accumulation. The average person looks at a loan application and sees a way to purchase a lifestyle they have not earned. But the wealthy person looks at a loan and sees a lever that can move mountains. You must understand that debt is not inherently evil, but it is a tool that requires extreme respect and absolute competence. If you lack the discipline to distinguish between an asset and a liability, debt will destroy you with a ruthlessness that you cannot imagine. The fundamental law of financial gravity is this: never borrow money to buy something that loses value. This is the golden rule of borrowing, and violating it is the primary reason why the middle class struggles to accumulate genuine net worth. You must stop looking at credit as an extension of your income, because it is not income. It is future labor sold at a discount. When you borrow for consumption, you are stealing from your future self to satisfy a momentary craving for status or pleasure. The vast majority of the population is trapped in a cycle of poverty, not because they do not earn enough money, but because they are addicted to consumer debt. You need to look in the mirror and ask yourself if you are borrowing to look rich or borrowing to become rich. When you use debt to buy a car, a television, a wedding, or a vacation, you are committing financial suicide because you are triggering a double negative effect that ravages your net worth. First, you are paying interest to a lender, which means the item costs you significantly more than its sticker price. Second, the item itself is suffering from depreciation, meaning it is losing value every single day you own it. You are paying a premium for a decaying asset. Imagine borrowing money at 10% interest to buy a luxury car that loses 20% of its value the moment you drive it off the lot. That is not just a bad decision. That is a mathematical catastrophe. By the time you finish paying off the loan, you will have paid perhaps $50,000 for a vehicle that is now worth $10,000. You have voluntarily incinerated $40,000 of your hard-earned wealth. This is how the banking system keeps you poor, by selling you the illusion of ownership while they harvest the interest on your ignorance. To break free from this cycle, you must undergo a radical shift in your mindset and start operating like a financial institution. You must understand that the purpose of a loan is not to acquire things, but to acquire assets. An asset is not your house, and it is certainly not your car. An asset is something that puts money into your pocket without you having to work for it. Cash flow is the heartbeat of financial freedom. When a sophisticated investor borrows money, They are not looking for satisfaction or status. They are looking for a stream of income that exceeds the cost of the debt. The only time you should ever sign your name to a loan document is when the mathematical projection of the return on investment, ROI, clearly and undeniably exceeds the cost of borrowing. This is the spread where wealth is created. If the bank charges you 6% interest for a loan, and you can invest that money into a business or a rental property that generates a 12% return, you are making a 6% profit on money that does not even belong to you. This is the magic of leverage. You are using other people's money to build your own fortune. Consider the example of real estate investment to illustrate this point perfectly. If you save your own cash to buy a rental property, it might take you 20 years to accumulate enough capital. However, if you use a mortgage, you can acquire that asset today. If the rent collected from the tenant covers the mortgage payment, the property taxes, the insurance, and the maintenance, and still leaves you with a surplus at the end of the month, that is positive cash flow. In this scenario, the debt is not your burden to bear. It is the tenant who is paying off your loan. You are effectively controlling a high-value asset with a fraction of the cost, and over time, the tenant pays down the principal while the property likely appreciates in value. This is how the rich get richer. They do not work for money. They create systems where their assets work for them, and they use debt to accelerate the acquisition of those assets. The debt is good debt because it is self-liquidating. The investment itself pays for the loan. However, you must be ruthless in your analysis because hope is not a strategy. Before you take on any debt for an investment, you must strip away all emotion and look strictly at the numbers. You must calculate the ROI with precision. If you are borrowing to expand your business, you must be certain that the new equipment or the new location will generate enough additional revenue to service the debt and provide a profit. If the numbers are thin, or if the profit depends on everything going perfectly according to plan, you must reject the loan. The wealthy do not gamble with debt. They calculate. They understand that leverage cuts both ways. Just as it amplifies your returns when things go well, it amplifies your losses when things go poorly. Therefore, you must never borrow based on speculation. You borrow based on proven cash flow and conservative projections. If the math does not show a clear profit after all expenses and interest payments are accounted for, then the deal is dead. Do not try to force it. The trap that ensnares many aspiring entrepreneurs is the confusion between revenue and profit. You cannot eat revenue. You can only spend profit. If you borrow money to scale a business that has fundamental flaws in its unit economics, you are merely scaling your losses. You must use debt only to pour fuel on a fire that is already burning bright, not to try and start a fire in the rain. You must also consider the liquidity and the terms of the loan. Short-term debt should never be used to finance long-term assets. This mismatch has bankrupted more businesses than perhaps any other error. You need to match the lifespan of the loan to the lifespan of the asset. If you are buying a piece of machinery that will last 10 years, you finance it over a period that ensures the cash flow from that machine pays for the debt. Furthermore, you must stop listening to the broke people around you who tell you that debt is necessary for a normal life. It is normal to be broke. It is normal to be stressed. It is normal to live paycheck to paycheck. If you want to be wealthy, you must be abnormal. You must be willing to drive an old car while you use your borrowing power to buy a duplex. You must be willing to live in a smaller house than you can afford so that you can use your credit capacity to acquire a business. Every dollar of credit you have is a finite resource. It is like a soldier in your army. If you send your soldiers to die on the battlefield of consumerism, buying clothes and dinners and gadgets, you have no army left to fight for your financial freedom. But if you deploy your soldiers into the trenches of investment, they will capture territory and bring back prisoners in the form of interest and dividends. Ultimately, the distinction comes down to delayed gratification. The poor and the middle class want their rewards now, so they borrow to buy the symbols of wealth. They look rich, but they are drowning. The truly wealthy are willing to delay their rewards. They live below their means and use debt strategically to build a foundation of assets. Only later, when the cash flow from those assets is overflowing, do they use that income to buy the luxuries. But they never ever use the debt itself to buy the luxury. The luxury is the reward for the investment, not the purpose of the loan. You must memorize this distinction. If you cannot pay cash for a toy, you cannot afford the toy. But if you cannot pay cash for an asset, you should absolutely consider borrowing for it, provided the asset pays for itself. Do not let fear paralyze you, but do not let greed blind you. There is a path to wealth that involves the intelligent use of leverage, but it is a narrow path lined with cliffs on both sides. You must walk it with your eyes wide open, armed with financial literacy and a calculator. Stop acting like a consumer who is easily manipulated by marketing and low monthly payments. Start thinking like a capitalist who demands a return on every single dollar that passes through your hands. The bank is not your friend, but it can be your partner if you are the one in control. If you let the bank dictate the terms, you lose. If you dictate the terms by only accepting loans that make you richer, you win. The choice is stark and the consequences are eternal. Will you borrow to feed your ego, or will you borrow to feed your bank account? The answer to that question will define your financial future. Make the shift today. Stop bleeding money on interest for things that rust and rot. Direct every ounce of your borrowing power toward things that grow, produce, and endure. This is the way of the wealthy. This is the only way to make debt work for you rather than against you. Chapter 2. Borrow only what you can sustain. Quote, "Creditors have better memories than debtors." You must engrave this quote into your mind before you ever sign a single document or shake hands with a loan officer. You are entering a domain where your optimism is your greatest enemy, and the memory of the institution that lends to you is infinite. The moment you accept capital from a lender, you are not merely accepting money. You are accepting a rigid, unforgiving schedule of repayment that does not care about your personal circumstances, your health, the economy, or your excuses. This chapter is not about how to get approved for a loan. It is about knowing when to walk away from an offer that looks like a lifeline but acts like a noose. The fundamental error that destroys financial futures is the belief that if a bank is willing to lend you a certain amount of money, you can afford to borrow it. This is a lie. The bank is in the business of selling debt. Their approval algorithms are designed to maximize their profit, not to ensure your financial safety. When a bank tells you that you are approved for $500,000, they are not giving you financial advice. They are telling you the mathematical limit of their risk tolerance, not yours. If you borrow up to that limit, you are living on the edge of a cliff where a single misstep will send you plummeting into insolvency. You must understand that the maximum approval amount is a trap for the ignorant. It is calculated based on your gross income under perfect conditions. It assumes you will remain employed, that your health will remain perfect, that the economy will remain stable, and that your other expenses will never rise. Life does not work this way. If you borrow the maximum amount the bank offers, you are leaving yourself with zero margin for error. You are effectively betting your entire financial future on the hope that nothing will ever go wrong. A wise borrower looks at the approval letter, laughs at the absurdity of the figure, and then calculates their own number based on a brutal assessment of reality. You must determine what you can sustain, not just what you can access. Sustainability is the only metric that matters. Can you sustain this payment if your income is cut in half? Can you sustain this payment if your spouse loses their job? Can you sustain this payment if you face a medical emergency that requires thousands of dollars in cash? If the answer is no, then the loan is too large, regardless of what the bank says. This brings us to the concept of stress testing your finances. In engineering, a stress test involves putting a material under extreme pressure to see when it breaks. You must do the exact same thing with your finances before you take on debt. You must simulate the worst-case scenarios. Sit down and look at your numbers and ask yourself what happens if interest rates rise by 2 or 3 percentage points. If you are taking a variable rate loan, this is not a hypothetical scenario. It is a near certainty over a long enough timeline. If a rise in interest rates turns your profitable investment into a monthly liability that drains your cash flow, you have failed the stress test. You must also ask what happens if your income drops by 20%. Perhaps you lose a major client, or your industry suffers a downturn, or your overtime hours are cut. If a 20% drop in income means you cannot make your loan payment, you are already insolvent. You just do not know it yet. You are driving a car with no brakes, hoping you never encounter a red light. We must speak about your debt-to-income ratio, or DTI. The banks have a standard ratio they accept, often allowing your debt payments to consume up to 43% or even 50% of your gross income. This is madness. If half of your income is legally promised to creditors before it even hits your bank account, you are a slave to your debt. You have no freedom. You have no ability to invest, to save, or to pivot when life changes. You must establish your own personal debt-to-income ratio limit that is far lower than the bank's limit. A safe borrower never allows their debt obligations to exceed 30% of their net take-home pay. Note that I said net pay, not gross pay. The bank looks at your gross income, but you cannot pay your mortgage with taxes. You pay your debts with the money that actually lands in your pocket. By using net income in a lower ratio, you build a fortress around your finances. This buffer is what saves you when the unexpected happens. It is the difference between a minor financial hiccup and a total collapse. Risk tolerance is a concept that is often discussed but rarely understood. Most people overestimate their risk tolerance because they confuse it with their desire for gain. You might think you have high risk tolerance because you want to make a lot of money, but true risk tolerance is measured by your ability to survive a loss. If the investment you are buying with this debt goes to zero, can you still service the debt? If the answer is no, you are not investing. You are gambling with money you do not have. You must strip away your optimism. Optimism is a wonderful tool for an entrepreneur, but it is a deadly poison for a borrower. When you are calculating your ability to repay, you must be a pessimist. You must assume that tenants will not pay rent, that the business will start slower than expected, and that maintenance costs will be double what you anticipated. If the numbers still work under these pessimistic assumptions, then and only then is the debt safe. If the numbers only work when everything goes perfectly, you are walking into a disaster. The catastrophe of default is not just a financial event, it is a life-altering trauma that lingers for years. When you default on a loan, you prove Benjamin Franklin right. The creditor will not forget. They will pursue legal judgments, they will garnish your wages, and they will destroy your credit score. This damage prevents you from leveraging good debt in the future. You will be locked out of the financial system, forced to pay exorbitant interest rates, or denied capital altogether. You must treat the obligation to repay as a sacred contract that cannot be broken. This is why you must never borrow up to your limit. You must always leave room to maneuver. You must always have a plan B, a plan C, and a plan D. The borrower who survives is the one who plans for the storm while the sun is shining. Solvency is not a static state. It is a dynamic relationship between your assets, your liabilities, and your cash flow. You can be asset-rich and cash-poor, and that is a dangerous place to be when you have debt service payments due every 30 days. The bank does not accept equity as payment. They demand cash. Therefore, part of borrowing what you can sustain involves ensuring you have the liquidity to service that debt during dry spells. You must not use all your cash reserves to acquire the asset. You must keep a liquidity buffer that covers 6 to 12 months of debt payments. This cash reserve is your insurance policy against the unpredictability of life. It buys you time. In the world of finance, time is the most valuable commodity. When you have cash, you can wait for the market to recover. When you have no cash and high debt, you are forced to sell at the bottom, cementing your losses and destroying your wealth. Do not let the allure of easy credit intoxicate you. The marketing departments of financial institutions are masters of psychology. They sell you dreams of home ownership, business success, and lifestyle upgrades, all packaged in a monthly payment that seems manageable on the surface. But they do not show you the stress of living paycheck to paycheck because your debt load is too heavy. They do not show you the panic of waking up at 3 in the morning wondering how you will pay the mortgage if you get laid off. You must be smarter than their marketing. You must be the guardian of your own financial gate. You must have the discipline to say no to money. Saying no to a loan that is too large is one of the most powerful financial moves you can make. It demonstrates that you value your freedom more than the immediate gratification of the asset. Ultimately, the decision to borrow must be grounded in cold, hard mathematics, not emotion. You must detach yourself from the excitement of the purchase and look at the commitment you are making. You are signing away your future labor. You are promising that for the next 10, 20, or 30 years, a portion of everything you earn belongs to someone else. Make sure that the portion you keep is enough to live a life of dignity and security. Do not become a servant to the lender. By borrowing only what you can sustain in your worst-case scenario, you maintain the balance of power. You use the debt. The debt does not use you. You remain the master of your financial destiny, capable of weathering storms and seizing opportunities, rather than being crushed by the weight of your own obligations. Remember that solvency is your primary directive. Growth is secondary to survival. You cannot compound wealth if you are bankrupt. Therefore, protect your downside with ferocity, stress test every assumption, and never, under any circumstances, borrow based on the best-case scenario. Chapter 3. The Trap. Why refinancing is often a mistake. Quote, "There are no shortcuts to any place worth going. You must understand that the financial industry is built upon the ignorance of the consumer, and nowhere is this more evident than in the aggressive marketing of refinancing. You are bombarded with offers to lower your monthly payments, to free up cash, and to ease your financial burden. But you must recognize this for what it is, which is a carefully designed trap meant to keep you in debt for the rest of your life. The bank is not your friend, and the loan officer is not a financial advisor looking out for your future. They are salespeople selling a product, and that product is debt. When they call you with an offer to refinance your mortgage or your personal loans because interest rates have dropped slightly, they are not doing it to save you money. They are doing it because refinancing is one of the most profitable transactions for a lending institution. You need to look past the attractive bold numbers on the flyer that show a lower monthly payment and start looking at the fine print that dictates your financial destiny. The reality is that refinancing is often a mistake that destroys your net worth under the guise of helping your cash flow. The primary mechanism of this deception is the manipulation of the loan term. You might be 10 years into a 30-year mortgage, meaning you have 20 years left to pay, and during those first 10 years, you have paid a staggering amount of interest while barely scratching the principal balance. This is how amortization works, as the banks front-load the interest payments so they get their profit first. If you choose to refinance now into a new 30-year loan to get a lower payment, you are not saving money. You are resetting the clock. You are taking a loan that had 20 years remaining and turning it back into a loan that has 30 years remaining. You have effectively volunteered to pay for your house for a total of 40 years instead of 30. The reduction in your monthly payment is not a magical savings. It is simply the result of spreading the remaining balance over a much longer period. You are renting money for a longer duration, and the total cost of that rental will be significantly higher. The illusion of savings is created by focusing your attention on the short-term cash flow rather than the long-term wealth destruction. You must also consider the devastating impact of refinancing costs, which are rarely discussed with the transparency they deserve. Refinancing is not free, and the bank will charge you closing costs, origination fees, appraisal fees, and administrative charges that can amount to thousands of dollars. The lender will often offer to roll these costs into the loan so you do not have to pay them out of pocket, telling you that it is a no closing cost refinance. Do not be fooled by this terminology, because there is no such thing as a free lunch in finance. When they add these fees to your loan balance, you are now paying interest on those fees for the next 30 years. You are paying interest on the privilege of paying interest. If the closing costs are $5,000 and you finance them over 30 years, that $5,000 could eventually cost you double or triple that amount. This erodes any potential savings you might have gained from a slightly lower interest rate. You have to calculate the break-even point to see how many months or years it will take for the monthly savings to actually cover the upfront cost of the refinance. If you plan to move or sell the asset before that break-even point, you have mathematically lost money on the deal. Furthermore, you need to be aware of the concept of prepayment penalties, which is a clause buried in many loan contracts. Some lenders attach these penalties to discourage you from paying off the loan early or refinancing with a competitor. If your current loan has a prepayment penalty, you could be charged a significant fee for the privilege of leaving, which further destroys the financial viability of refinancing. You must read your original contract with a magnifying glass before you even consider a new offer. The banks count on the fact that you will not read the paperwork and that you will simply sign where the sticker indicates. They rely on your laziness and your desire for immediate gratification. The promise of an extra $200 in your pocket this month blinds you to the fact that you are signing away tens of thousands of dollars of your future net worth. It is a psychological game, and you are the prey.
Another critical aspect you must understand is that a lower interest rate does not automatically equate to a lower cost of borrowing. This is the greatest mathematical lie told to consumers. You can have a lower interest rate, but still pay more in total interest if the term of the loan is extended. For example, if you have a loan at 6% interest with 15 years remaining, and you refinance to a loan at 5% interest, but extend the term back to 30 years, you will pay significantly more total interest on the new loan despite the lower rate. The time factor is more powerful than the rate factor. Interest creates a snowball effect over time, and by extending the time, you are allowing the snowball to grow larger and larger. The only time refinancing makes mathematical sense is if you can lower the interest rate significantly, while keeping the loan term the same or shortening it. If you can go from a 30-year loan to a 15-year loan and lower your rate, then you are winning. But if you are extending the term, you are losing, regardless of how low the rate is. You must also guard against the temptation of the cash-out refinance, which is perhaps the most dangerous financial product available to the average consumer. This allows you to refinance your home for more than you owe and take the difference in cash. People use this equity to buy cars, pay for weddings, or go on vacations, thinking they are being smart by using cheap mortgage debt. This is financial suicide. You are taking unsecured consumer spending and securing it against your home, putting your shelter at risk. You are taking an asset that should be paying you and turning it into an ATM machine that drains your wealth. When you strip the equity out of your home, you are increasing your leverage and your risk. If the market turns and property values drop, you could find yourself underwater, owing more on the house than it is worth, trapped in a home you cannot sell. The cash-out refinance is the ultimate tool for turning a homeowner back into a debtor. The bank wants you to stay in debt forever because you are their asset. Your debt is their income. When you pay off your mortgage, the bank loses an income stream. Therefore, their entire business model is designed to keep you in the cycle of debt for as long as possible. Refinancing is their way of resetting the hook just when you are starting to wiggle free. They see you approaching the years where you would finally start paying down significant principal, and they intervene with a shiny offer to lower your payments. They want to push you back to the beginning of the amortization schedule, where the interest payments are highest. You must have the discipline to say no. You must have the foresight to look at the total interest cost over the life of the loan, rather than just the monthly payment. You must realize that the goal is to be debt-free, not to have a comfortable monthly debt payment. There are rare exceptions where refinancing is a valid strategy, but they are few and far between. If you have an adjustable rate mortgage that is about to explode into a much higher rate, refinancing into a fixed rate loan is a safety maneuver. If your credit score has improved dramatically since you first took out the loan, and you can secure a vastly superior rate without extending the term, it might be worth investigating. However, these decisions must be made with a calculator in hand and a cynical mindset. You must demand a side-by-side comparison of the total interest paid on your current trajectory versus the new proposal. You will often find that the banker becomes uncomfortable when you ask for these specific figures because the math exposes the scam. They want to talk about monthly cash flow. You must force the conversation to total cost of capital. Ultimately, the decision to refinance is a test of your financial literacy and your ability to delay gratification. The easy path is to take the lower payment and ignore the long-term consequences. The hard path, the path worth going, is to stay the course, pay down the principal, and refuse to let the bank reset the clock on your freedom. Do not let the illusion of short-term savings rob you of your long-term wealth. You are playing a game against professionals who do this for a living, and if you do not understand the rules, you will lose. Stand firm, do the math, and realize that the fastest way out of debt is usually to pay it off, not to restructure it. The trap is set, the bait is the lower monthly payment, and the cage is the extended term. Do not walk into it willingly. You must be smarter than the system that is designed to keep you poor. Stay focused on the total elimination of the debt, not the management of the payments, and you will see through the smoke and mirrors of the refinancing industry. Chapter 4. The Accelerator, Channeling Income. Boosts to Principal. Quote, "Don't save what is left after spending. Spend what is left after saving." You are likely operating under a delusion that is keeping you shackled to mediocrity and perpetual debt. The delusion is the belief that when your income increases, your standard of living must immediately rise to meet it. This phenomenon is known as lifestyle creep, and it is the single most destructive force preventing you from achieving financial freedom. When you receive a raise, a bonus, or a sudden windfall, your instinct is to celebrate. You convince yourself that you have worked hard, and therefore you deserve a reward. You look at that new influx of capital and immediately think of the car you can upgrade, the vacation you can book, or the clothes you can buy. This is the mindset of the eternal consumer, and it is exactly what the banks are counting on you to do. The banks want you to spend that money on consumer goods while maintaining your minimum payments on their loans, because that ensures you remain a profitable servant to their interest rates for the maximum amount of time. You must reject this weakness. This chapter demands a fundamental shift in your psychological approach to income. From this moment forward, any increase in your income does not belong to you. It belongs to your debt. You must understand the mathematical reality of your situation. Every day that you hold a balance on a loan, you are bleeding money. Interest is the penalty you pay for using someone else's capital, and it is calculated based on the outstanding principal balance. The majority of borrowers simply pay the monthly minimum, oblivious to the fact that in the early stages of a loan, the vast majority of that payment is devoured by interest, with only a fraction touching the actual debt. This is how a 30-year mortgage or a 5-year car loan extracts the maximum amount of wealth from your pocket. However, you possess a weapon that can destroy this cycle, and that weapon is principal paydown. When you make a payment that is specifically designated for the principal balance, you are not just reducing the debt by that amount. You are eliminating all the future interest that would have accrued on that specific amount of money. You are effectively buying back your own future. This is why you must view every dollar that enters your life above your baseline survival needs as a soldier to be deployed in the war against your debt. Consider the concept of the living wage you are currently on. If you are surviving today on your current salary, then you have proven that you do not need more money to exist. Therefore, when your employer grants you a 5% raise, that money is surplus. The average person absorbs that 5% into their daily spending, till it disappears without a trace. You will not do this. You will pretend that the raise never happened. You will maintain your lifestyle exactly where it is, and you will channel 100% of that increase directly into an accelerated repayment plan. If you were managing to pay your bills before the raise, you can continue to do so now. The difference is that the new capital is now a freedom fund that is exclusively dedicated to attacking the principal of your loans. By doing this, you are artificially suppressing your lifestyle to accelerate the destruction of your liabilities. It requires discipline, and it requires the ability to delay gratification. But the mathematical result is undeniable. A loan that was scheduled to enslave you for 10 years can be eliminated in 4 years simply by directing all future income growth toward the balance. Let us discuss the concept of windfalls. A windfall is any sum of money that lands in your lap outside of your regular paycheck. This includes tax refunds, annual performance bonuses, inheritance, or profits from a side hustle. The amateur looks at a $2,000 tax refund as free money to be blown on a new television or a weekend getaway. The financial master looks at a tax refund as a sniper shot to the heart of their debt. If you have a credit card balance charging you 20% interest, using a windfall to buy a consumer good is an act of financial insanity. You are effectively borrowing money at 20% to buy a toy. When you receive a windfall, it must not even touch your checking account for more than the time it takes to transfer it to your lender. You must be ruthless with these amounts. You might feel a pang of jealousy when you see your peers spending their bonuses on luxury items, but you must realize that they are merely polishing the bars of their cage. You are buying the key to unlock yours. The danger of lifestyle creep is insidious because it happens slowly. It starts with ordering expensive coffee, then upgrading your car lease, then moving to a slightly more expensive apartment. Before you realize it, your expenses have risen to match your new income, and you have zero margin left to pay down debt. You are running faster just to stay in the same place. To combat this, you must anchor your lifestyle to your old income. If you made $50,000 last year, and you make $60,000 this year, your budget must remain set at the $50,000 level. The $10,000 difference is not for you. It is for the bank. It is the ransom payment to buy your freedom. You must visualize the interest savings. If you pay an extra $10,000 on your mortgage principal today, you are saving yourself potentially $20,000 in interest payments over the life of the loan. That is a guaranteed return on investment that no stock market can promise you. It is risk-free, tax-free wealth creation. There is a technical aspect to this strategy that you must execute correctly. When you send extra money to a lender, many banks will deceptively apply that money toward future payments rather than the principal balance. This is a trap. If they apply it to future payments, they are simply prepaying the interest for next month, and you gain no advantage in reducing the total cost of the loan. You must explicitly instruct your lender, in writing or through their payment portal, that every single cent of the extra payment is to be applied to the principal only. You must verify this on your monthly statement. If the principal balance does not drop by the exact amount of your extra payment, you must call them and demand they correct it. Do not trust the bank to do the right thing. Their incentive is to keep you in debt. You must be the aggressor who forces the capital to go where it serves you best. The concept of accelerated repayment is not just about mathematics, it is about psychology and momentum. When you see your loan balance dropping by huge chunks because you threw your entire bonus at it, you gain a sense of power and control. You stop feeling like a victim of the system and start feeling like the architect of your future. This momentum feeds on itself. You will start looking for other ways to generate cash. You will start a side hustle not to buy shoes, but to kill the student loan. You will sell items you do not need, not to buy dinner, but to lower the car note. The goal becomes the elimination of the debt, and the income increases are merely the fuel for the fire. You must become obsessed with the idea that you are buying time. Every $1,000 of debt you eliminate early is a month of your life that you do not have to work to pay a banker. Do not listen to the siren song of society that tells you to upgrade your life. Society is broke. The average person is drowning in payments because they upgraded their lifestyle every time they got a 50-cent raise. You are playing a different game. You are playing for total liberation. Until the debt is zero, you are broke. It does not matter if you make 6 figures. If your net worth is negative because of massive liabilities, you are technically worth less than zero. Your income is your shovel, and you are in a deep hole. When the shovel gets bigger because of a raise, you do not use it to dig a wider hole. You use it to fill the hole faster. This requires a hardness of mind that most people do not possess. They are soft. They want the reward before the victory. You must be hard. You must accept that your current standard of living is sufficient until the shackles of debt are broken. Ultimately, this chapter is a test of your character. It tests whether you value appearance or substance. Lifestyle creep is the pursuit of appearance. It is looking rich while being poor. Principal paydown is the pursuit of substance. It is living modestly while becoming wealthy. The choice is binary. You cannot do both. You cannot inflate your lifestyle and destroy your debt simultaneously. You must choose one. If you choose to channel every income boost to principal, you will eventually reach a tipping point where the debt is gone. And on that day, when the raise comes, it will actually be yours to keep. You will have earned the right to spend it because you will no longer be a servant to a lender. Until then, every raise, every bonus, and every found dollar is a prisoner of war that must be exchanged for your freedom. Do not hesitate. Do not negotiate. Send the money to the principal and never look back. Chapter 5. The Blueprint. Stick to your budget. Quote, "A budget is telling your money where to go instead of wondering where it went." You are currently standing on a battlefield where the enemy is your own lack of discipline, and the weapon of choice is a strict, unyielding budget. You must understand that debt cannot be managed without a map, and attempting to navigate the treacherous waters of financial obligation without a clear plan is nothing short of financial suicide. You are likely bleeding money without even realizing it, and the only tourniquet available to save your financial life is a zero-based budget. This is not a suggestion for your leisure. It is a mandatory requirement for your survival. When you took on a loan, you signed a contract with a lender. But the budget you create today is the contract you sign with yourself. It is the blueprint of your integrity and the undeniable proof of your commitment to freedom. You must stop viewing a budget as a restriction that limits your fun, and start viewing it as the only tool that gives you permission to spend without guilt and the power to destroy your debt systematically. The concept of zero-based budgeting is the foundation upon which your financial house must be built. This method requires that you take every single dollar of your income and assign it a specific task before the month even begins. You do not wait until the end of the month to see what is left over, because nothing will ever be left over if you do not command it to stay. Income minus expenses must equal zero. This does not mean you have $0 in your bank account. It means you have $0 that do not have a name and a purpose. If you earn $3,000, every single penny of that $3,000 must be allocated to a category. You allocate money for food, you allocate money for shelter, you allocate money for utilities, and most importantly, you allocate every remaining cent to your debt service. If you leave money unassigned, it will disappear into the void of frivolous spending. You will buy coffee you do not need, you will subscribe to services you do not watch, and you will eat out at restaurants you cannot afford. This is what we call leakage, and it is the silent killer of wealth. A small leak will sink a great ship, and your small, unnoticeable spending habits are destroying your ability to make your loan payments effectively. You must become ruthless with your expense tracking. You cannot manage what you do not measure. Most people live in a fantasy world where they believe they spend far less than they actually do. You need to confront the brutal reality of your bank statement. You must look at every transaction from the last 3 months and categorize it. You will likely be horrified to discover how much capital you have wasted on things that bring you no value and keep you trapped in the cycle of debt. This realization should make you angry. You should be angry that you have been working hard only to hand your money over to corporations for temporary pleasures, while your loan balance remains stagnant. Use that anger to fuel your discipline. When you are in debt, you do not have the luxury of casual spending. You are in a state of financial emergency, and your spending must reflect that urgency. Every dollar you spend on a luxury is a dollar you are stealing from your future self. It is a dollar that could have reduced your principal balance and saved you interest. You must stop stealing from your own future. The hierarchy of your allocation is critical. You must prioritize your loan obligations immediately after your absolute necessities. Your first priority is food, but not steak and lobster. We are talking about basic groceries to keep you alive and healthy. Your second priority is shelter, keeping a roof over your head and the lights on. Once these 4 walls are secure, the very next dollar goes to your lender. The loan payment is not optional. It is not something you pay if you have enough money left after a weekend of entertainment. It takes precedence over new clothes. It takes precedence over vacations. And it takes precedence over upgrading your technology. You must treat the minimum payment as a floor, not a ceiling. Your budget should be designed to squeeze every ounce of excess fat from your lifestyle, so that you can throw massive chunks of cash at your debt. This is how you win. You strip your life down to the essentials, and you attack the debt with the ferocity of a predator. You must understand that a budget is active, not passive. You do not write it down on a piece of paper and then stuff it in a drawer to be forgotten. You must engage with it every single day. You must track your spending in real time. When you go to the grocery store, you deduct that amount from your food category immediately. When the gas tank is full, you record the transaction instantly. If you wait until the end of the week, you will forget, and your numbers will be wrong. Precision is your ally. You must know exactly how much money remains in every single category at any given moment. If you overspend in one category, you must immediately take that money from another category to balance the equation. You cannot simply spend more. That option is off the table. If you spend too much on electricity this month, you eat less or you drive less. The bottom line does not change. The mathematics of your life are unforgiving, and the sooner you accept that, the sooner you will gain control. There is a psychological component to this rigorous budgeting that you cannot ignore. When you live without a budget, you live with a low-level hum of anxiety. You are constantly wondering if a check will clear or if you will have enough money to make it to the next payday. This stress eats away at your peace of mind and affects your health, your relationships, and your work performance. However, when you create a strict budget and stick to it, that anxiety is replaced by a sense of power. You are no longer a victim of your circumstances. You are the master of your resources. You know exactly what is coming in and exactly what is going out. There are no surprises. You have accounted for your car repairs. You have accounted for your insurance premiums. And you have accounted for your debt payments. This clarity allows you to sleep at night. You know that you are doing everything within your power to meet your obligations. You are preserving your creditworthiness, which is your reputation in the financial world. A person who budgets is a person who can be trusted. A person who budgets is a person who honors their word. Do not make the mistake of thinking that you are too smart or too rich to budget. Corporations worth billions of dollars operate on strict budgets. Governments operate on budgets. Successful investors operate on budgets. If entities with practically unlimited resources require a budget to function effectively, what makes you think you can survive without one? It is arrogance to believe you can outsmart the math. You cannot. The numbers will always win. You must align yourself with the reality of the numbers. You must fall in love with the process of allocation. You should derive satisfaction from seeing your loan balance decrease because you sacrificed a dinner out. You should feel pride when you decline an invitation to an expensive event because it does not fit into your plan. This is not deprivation. This is tactical maneuvering. You are sacrificing the short term for the long term. You are giving up the appearance of wealth today to have actual wealth tomorrow. This chapter is your wake-up call. The time for excuses is over. The time for saying you will start next month is over. You must start today. You must sit down with your bank statements, your pay stubs, and your loan documents. You must face the mess you have made, and you must create a plan to clean it up. It will be uncomfortable. It will be difficult. You will have to say no to yourself and to others. You will have to change your habits, your lifestyle, and your mindset. But if you stick to this blueprint, if you adhere to this zero-based budget with religious fervor, you will not only pay off your debt, but you will also build a character of steel. You will learn the value of $1. You will learn the power of delayed gratification. You will emerge from this process not just debt-free, but financially sophisticated and unbreakable. The budget is your sword and your shield. Pick it up and fight for your life. Chapter 6. The Psychological Game of Debt. Quote, "Discipline is choosing between what you want now and what you want most." You must understand that debt is not merely a mathematical equation that you solve with a calculator. For if debt were simply a matter of arithmetic, then nobody would ever struggle with it. Everyone knows that spending more than you earn equals poverty. Yet millions of intelligent and educated people fall into this trap every single day because debt is actually 20% mathematics and 80% behavior. You are not fighting against numbers on a spreadsheet, but rather you are fighting against your own psychology and millions of years of biological programming that demands instant gratification. The financial industry knows this about you, and they spend billions of dollars every year to exploit your psychological weaknesses. So if you do not master your mind, you will forever remain a slave to their system. This chapter is about the psychological warfare of finance, and it is time for you to arm yourself with the truth about why you do what you do. The primary reason you borrow money for consumer goods is not because you need them, but because you are addicted to the dopamine hit that comes with the purchase. When you see a new car or a new phone or a vacation that you cannot afford, your brain releases a chemical reward that feels like pleasure, and the credit card is the tool that allows you to access that pleasure immediately without the pain of paying for it. You are essentially drug-seeking, but the drug is consumption, and the dealer is the bank. The problem is that the pleasure of the purchase fades within days or even hours, but the pain of the payment lingers for months or years. You are trading your future freedom for a fleeting moment of excitement. You must recognize that this is a biological trap designed to keep you poor. The marketing messages you see every day are designed to bypass your logical brain and appeal directly to your emotional center, telling you that you deserve this item now and that you are not successful unless you display these symbols of wealth. You must reject this narrative completely if you ever want to be truly wealthy. Consider the mental burden that you carry when you owe money to others. Debt acts as a low-frequency stress signal that never truly goes away, effectively running in the background of your mind like a computer program that drains your battery. You might not think about your debt every single second, but it is there when you wake up in the morning, and it is there when you go to sleep at night. It influences your decisions, limits your options, and creates a subtle anxiety that erodes your quality of life. When you are in debt, you do not own your time, because your time belongs to your creditors. You cannot leave a job you hate because you have payments to make. You cannot take risks on a new business idea because you cannot afford to fail. You are trapped in a cage of your own making, and the bars of that cage are the monthly payments that you signed up for. True financial freedom is not just about having a lot of money. It is about the absence of financial anxiety. It is the peace of mind that comes from knowing that you own your life completely, and that no bank has a claim on your future labor. You must fundamentally shift your identity from being a consumer to being a capital allocator. A consumer sees money as a voucher to be exchanged for goods and services that bring temporary happiness. A capital allocator sees money as a tool, a soldier, or a seed that must be planted to grow more resources. When a consumer sees $1,000, they think about what they can buy with it. When a capital allocator sees $1,000, they think about how they can invest it to generate a return. This shift in mindset is the most critical step you will ever take. You must stop looking at your credit limit as available money, because it is not your money. It is debt waiting to happen. You must stop looking at monthly payments as the price of a product, and start looking at the total cost, including interest and the opportunity cost of what that money could have earned if you had invested it instead. The moment you stop trying to look rich and start trying to be rich is the moment you begin to win. Behavioral finance teaches us that human beings are naturally terrible at estimating long-term consequences. We are wired to prioritize the present moment over the future, which is why we eat unhealthy food, skip the gym, and spend money we do not have. To overcome this, you must build systems that protect you from your own impulses. You cannot rely on willpower alone, because willpower is a limited resource that runs out when you are tired or stressed. You need to create friction between your impulse to spend and the actual transaction. You must remove your credit cards from your online accounts, freeze your credit, and force yourself to wait 24 hours before making any purchase over a certain amount. This forces your logical brain to catch up with your emotional brain. You will often find that after a day of waiting, the burning desire to buy the item has completely vanished. This proves that the desire was just a temporary emotional spike and not a genuine need. Discipline is the bridge between your goals and your accomplishments. It is the ability to tell yourself no when everything around you is screaming yes. It is the strength to drive an old car while your peers are driving new ones that they cannot afford. It is the resolve to cook at home when you are tired because you know that ordering expensive food delays your debt payoff date. This kind of discipline is painful in the short term, but it is the only path to long-term glory. You must learn to fall in love with the process of denial, not because you are punishing yourself, but because you are rewarding your future self. Every time you refuse to borrow money for a liability, you are buying back a piece of your freedom. You are telling the banks that they cannot have your future. You are reclaiming your sovereignty. The psychological weight of owing money ruins relationships and destroys families. Financial stress is one of the leading causes of divorce, because when money is tight, patience wears thin, and every conversation becomes a potential conflict. When you are drowning in debt, you are not fully present for your spouse or your children, because a part of your mind is always worrying about the next bill. By eliminating consumer debt, you are not just fixing your bank account. You are healing your relationships and creating a stable environment for your family. You are demonstrating to those around you that you are a person of character who values security over status. The peace that comes into a home when there are no payments is palpable and profound. It changes the atmosphere of your entire life. You must understand that the system is rigged to keep you in a cycle of consumption and repayment. The entire economy is built on the premise that you will spend everything you earn and then borrow more. When you choose to step out of this cycle, you are committing a revolutionary act. You are rejecting the script that has been written for you. It requires a tremendous amount of mental fortitude to swim against the current of culture. People will mock you for being cheap or for not having the latest gadgets. They will not understand why you are so intense about paying off your loans. Do not listen to them. They are likely broke and trying to look rich while you are on the path to becoming truly wealthy. Their opinion does not pay your bills, and it certainly does not build your net worth. The ultimate goal of this psychological shift is to reach a point where you do not need to impress anyone. When you are truly secure in your financial position, you lose the desire to flash your wealth. You realize that true wealth is what you do not see. It is the money in the investment account that is compounding year after year. It is the paid-off house. It is the ability to walk away from a toxic job. It is the freedom to sleep soundly at night without a single worry about a creditor calling you. This is the prize that awaits you, but you can only achieve it if you win the battle in your mind first. You must decide today that you are done being a victim of your own impulses. You must decide that your peace of mind is more valuable than any material possession. You must embrace the discipline of the capital allocator and reject the slavery of the consumer. The journey out of debt is not a straight line, and there will be days when you want to give up and go back to your old ways. There will be times when the emotional pull of retail therapy feels overwhelming. In those moments, you must remember your why. You must visualize the freedom that you are fighting for. You must remind yourself that the pain of discipline weighs ounces, while the pain of regret weighs tons. Do not let a moment of weakness destroy a lifetime of freedom. You have the power to rewire your brain and change your relationship with money. It starts with a decision, and it is sustained by daily action. You are not a number. You are not a credit score. You are the master of your destiny, but only if you take control of the psychological game of debt. The choice is yours, and the time to choose is now. Do not wait for a miracle. You are the miracle. Stop borrowing your future and start owning your life. Chapter 7. The Exit Strategy. From Debtor to Investor. Quote, "The rich rule over the poor, and the borrower is slave to the lender." You must etch these ancient words into the very foundation of your consciousness, because they describe the fundamental reality of the economic world in which you live and breathe. There is no middle ground in the game of finance, for you are either the master of your money or you are its servant, and up until this moment you have likely been serving a master that does not care about your well-being, your family, or your future. This chapter marks the definitive end of your servitude and the beginning of your reign as the sovereign ruler of your own capital. You have spent chapters learning how to stop the bleeding, how to cut the chains of bad debt, and how to stabilize your financial vessel. But stability is not the destination, for it is merely the platform from which you launch. The exit strategy is not simply about getting to zero, because zero is not wealth. Zero is merely the absence of a negative, and you were not born to simply exist at a baseline of nothingness. You were born to build, to grow, and to leave a mark. And that requires you to transition from the mindset of a debtor who scrambles to survive to the mindset of an investor who strategically conquers. The transition from paying interest to earning interest is the most powerful financial maneuver you will ever execute in your lifetime. Think about the thousands of dollars you have handed over to banks, credit card companies, and lenders over the last decade. That money was your labor, your time, and your life force converted into currency, and then willingly handed over to build someone else's empire. You were the fuel for their engine. Now, you must reverse the polarity of your financial flow. The moment you pay off a liability, you create a vacuum in your cash flow, and nature abhors a vacuum. If you had a car payment of $500 a month, and you finally pay it off, you suddenly have $500 freed up every single month. The average person, the one who remains poor in mind and spirit, looks at that freed capital and immediately thinks of a way to consume it. They think they have given themselves a raise, so they upgrade their lifestyle. They eat out more frequently, or they finance a newer, more expensive car. You must not do this. You must treat that liberated cash flow as if it still does not belong to you for consumption purposes. You must take that payment that used to go to the bank and immediately redirect it into an investment vehicle. You are not spending less money. You are simply changing the recipient of the payment from a creditor to your own future self. Capital allocation is the high-level skill that separates the wealthy from the working class. While the worker focuses on earning wages, the investor focuses on where to place those wages so they multiply. You must understand that money is a terrible master, but an excellent employee. When you leave money sitting in a bank account, it is lazy. It sleeps, and it slowly dies due to the erosion of inflation. When you send money to pay off consumer debt, you are killing the enemy, which is necessary, But you are not yet recruiting soldiers. Now that the enemy is defeated, you must deploy your capital into the battlefield of the market to capture territory. This territory comes in the form of stocks, real estate, and business equity. These are the three pillars of true wealth. When you buy a stock, you are not gambling. You are buying a piece of a company that has thousands of employees working to generate a profit for you. When you buy real estate, you are purchasing a physical asset that provides utility and generates rental incomes while someone else pays down the mortgage. When you invest in a business, you are building a system that solves problems and generates value. Your goal is to accumulate enough of these income-generating assets that the cash flow they produce covers your monthly living expenses. This is the definition of financial freedom. It is not a vague dream of being a billionaire. It is a precise mathematical equation. If your life costs $5,000 a month to maintain, and your assets generate $5,001 a month in passive income, you are free. You no longer have to work for money. You work because you choose to. You have broken the connection between your time and your income. This is the exit strategy. It is the exit from the rat race. It is the exit from the anxiety of living paycheck to paycheck. But to get there, you must be aggressive. You cannot tiptoe your way to wealth. You must attack your investment portfolio with the same intensity and ferocity that you used to attack your debt. If you were paying $2,000 a month to service debt, you should now be contributing $2,000 a month to your investment accounts. Do not tell me you cannot afford it, because you were already paying it when it was mandatory. The only difference now is that the payment is voluntary, and that is where discipline is tested. The bank forced you to pay them with the threat of foreclosure and ruined credit. No one will force you to become wealthy. You must force yourself. Consider the concept of the legacy you are building. If you die with debt, you leave a mess for your family to clean up, and you leave them starting at a deficit. If you die with a paid-off lifestyle and a portfolio of assets, you change the trajectory of your family line for generations to come. You become the patriarch or matriarch who shifted the family name from the column of labor to the column of capital. This is why you must not rest when the debt is gone. The danger of complacency is real. When the pressure of debt lifts, the human tendency is to exhale and relax. You must resist this urge with every fiber of your being. The moment you are debt-free is the moment you are most vulnerable to lifestyle creep. You will feel rich because you have cash in the bank, but you are not rich yet. You are merely liquid. True wealth is not cash. True wealth is cash flow derived from assets. You must fall in love with the process of buying income. Every dollar you spend on a liability is a dollar that could have been an employee working for you forever. When you buy a pair of shoes you do not need, you are not just spending the price of the shoes, you are killing the investment potential of that money. You are destroying the compound interest that those dollars could have earned over the next 30 years. You must develop an obsession with the return on investment. Before you deploy a single dollar, you must ask yourself what that dollar will return to you. If the answer is nothing, or if the answer is that it will lose value, you must have a very good reason for parting with it. The wealthy do not buy luxuries from their wages. They buy luxuries from the income generated by their assets. If you want the luxury car, you do not take out a loan for it. You buy a rental property, and you use the cash flow from the rental property to pay for the lease on the car. In this scenario, you get the car, but you keep the asset. The poor man buys the car and loses the capital. The rich man buys the asset and enjoys the car as a byproduct. This is the fundamental difference in philosophy that you must adopt. You must stop thinking about what you can buy and start thinking about what you can build. The exit strategy is about building a fortress of solitude around your finances so that no economic downturn, no job loss, and no market crash can destroy you. When you optimize your good debt, such as a mortgage on a rental property or a loan for a business expansion, you are using the bank's money to increase your returns. This is the advanced level of the game. You are no longer the slave. You are the partner. You are using the bank's capital to acquire assets that yield a higher return than the interest rate you are paying. This is called positive leverage, but you must respect the risk. Leverage cuts both ways. You must never become arrogant. You must always maintain a liquidity buffer, a cash reserve that protects you from the unexpected. The investor who uses all his cash is just as vulnerable as the debtor who has none. You must balance aggression with prudence. You must be bold in your vision, but conservative in your calculations. Do not assume the best-case scenario will always happen. Plan for vacancies, plan for market corrections, and plan for expenses. If the numbers still work in the worst-case scenario, then you have a solid investment. Ultimately, the exit strategy is a journey of self-mastery. It is about conquering your own impulses for instant gratification. It is about having the vision to see 10, 20, or 30 years into the future. It is about understanding that the sacrifices you make today are purchasing the freedom you will enjoy tomorrow. You have the knowledge now. You understand the trap of bad debt. You understand the power of budgeting. You understand the necessity of an emergency fund. Now you must execute. You must take the final step and become an investor. You must look at the stock market not as a casino, but as a grocery store where you buy companies on sale. You must look at real estate not as a headache, but as a wealth generator. You must look at your own business potential not as a risk, but as the only vehicle for unlimited income. The world is filled with people who drift through life, pushed around by financial currents they do not understand. You are no longer one of them. You are the captain of your ship. You have the map, and you have the rudder. Steer the ship toward the horizon of financial independence. Do not let fear hold you back. The fear of investing is the fear of the unknown, but the risk of not investing is a certainty. If you do not invest, your money will lose value, and you will work until the day you die. That is a guarantee. Investing carries risk, but it is the only path to freedom. Educate yourself, read books, study the markets, and learn from those who have already achieved what you desire. Do not take advice from broke people. Do not take advice from your neighbor who drives a leased luxury car and has zero net worth. Take advice from those who have the fruit on the tree. Model their behavior, mimic their strategies, and most importantly, take action. Knowledge without action is merely potential energy. You must convert it into kinetic energy. You must open the brokerage account. You must make the offer on the property. You must start the business. The time for analysis paralysis is over. The time for action is now. Your legacy depends on what you do next. Will you pass down a mountain of bills and a history of financial struggle, or will you pass down a portfolio of assets and a blueprint for wealth? The choice is entirely yours. The chains are off. The prison door is open. Walk through it and claim the life that you deserve. You are a sovereign individual, capable of creating immense value. Do not squander your potential. Make your money work harder than you do. Build a machine that produces wealth while you sleep. This is the exit strategy. This is the end game. And it is the beginning of true life. Do not look back at the Egypt of debt. Look forward to the promised land of ownership. The journey is long, and it will not be easy, but it will be worth it. You have the power to change your family tree forever. Go forth and multiply your talents. Be fruitful and conquer. You are the investor now. Act like it.